Can China's PMI divergence signal a turning point in 2026? China's official manufacturing PMI dropped to 49.3% in January 2026, below the 50 expansion mark. Even as production stayed positive, that gap, output still growing while demanding weakens, could signal a structural shift in economic momentum. Where demand goes next could matter more than headline GDP figures. Official statistics from January 2026 show overall manufacturing PMI 49.3% contraction signal, production sub-index 50.6% expansion, new orders sub-index 49.2% demand softening, employment index 48.1% weaker labor demand. Large firms remain above the expansion threshold, while medium and small firms stayed below it, suggesting a divergence in performance by enterprise size. At the same time, high-tech manufacturing showed above a 50 readings, indicating resilience in certain segments. Comparatively, global manufacturing PMI data also shows uneven dynamics. While global PMI moved back above 50 in January, ASEAN region remained close to marginal expansion, and global demand uncertainty persists. This combination, domestic PMI below 50 on headline terms but with selective expansion and divergent sub-indices, points to structural heterogeneity rather than simple expansion or contraction. From a policy standpoint, recent measures including cyclical support and investment incentives have helped stabilize large enterprises and capital-intensive sectors, but aggregate demand weakness, especially among smaller firms and export-linked segments, continues to temper broad-based recovery expectations. Moreover, international institutions such as the IMF continue to critique structural balances in China's industrial policy, including resources allocation and trade surplus concerns, urging gradual adjustments as part of broader economic rebalancing. This mix of data and external feedback suggests that the PMI divergence may not be a short-term blip, but part of the broader recalibration of growth drivers.